gold it's time for gold now. I think all the pieces are in place for gold to become a much bigger part of the macro conversation. I think the reasons for owning gold have been strong for a while, but they're starting to be strong for a lot more different groups of people, particularly the central banks. So we've seen them buying more gold the last 2 years than they have since 1950, and that's important because they don't care what the price is. They just need to own it and diversify out of their currency reserves into a neutral reserve asset. So I think there's a lot of tailwinds for gold. And that explains why central banks are moving to acquire gold, and I think that is going to make gold more of a geopolitical asset. It's going to be a tailwind for the price. I think that's a big part of why we're going to see a good year for gold this year.
GrantWilliams, a renowned financial market commentator, expresses optimism regarding the future trajectory of gold, attributing its potential growth to factors such as central bank acquisitions and its increasing geopolitical significance. In line with Williams's outlook, UBS forecasts continued price hikes for gold and silver throughout 2024, driven by the U.S. Federal Reserve's expectations of interest rate cuts. This projection comes amid heightened demand for bullion as a safe haven asset, which has seen gold prices soar to an unprecedented high of $2,100 per ounce last month. Highlighting the geopolitical importance of gold, Williams underscores the trend of central banks increasingly acquiring gold reserves as a strategic measure for national security. Joni Teves, a strategist at UBS, supports this sentiment by suggesting that investors are inclined to bolster their gold allocations amidst macroeconomic uncertainties and geopolitical risks. Recent data from GSC Commodity Intelligence, Chinese investors, reveals a notable surge in gold accumulation among households, banks, and investors in China. Furthermore, the net increase in global central bank gold reserves by 28 tons in December 2023, with gross purchases of 41 tons outweighing gross sales of 12 tons, underscores the continued strength of gold buying. This trend aligns with the broader narrative of global central banks bolstering their gold reserves throughout 2023. Moreover, Williams anticipates a potential escalation in gold's outperformance, particularly in response to any instability in equity markets, a scenario expected to unfold before the year's end. This prediction aligns with the struggles faced by China's stock market since its peak in February 2021, resulting in the erosion of approximately $6 trillion in stock value over the past 3 years, significantly impacting the country's economic landscape. Join us as we delve into insights shared by GrantWilliams. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
And the next couple of years could be big years for gold. I'm very happy to talk about gold often, but I don't normally come out and say, I think this is going to be a good year. I've done it 2 or 3 times, and my track record has been pretty decent with those times. I don't think of it as something to buy and sell. I think of it as a liquidity reserve. I think of it as a hedge against inflation. I think of it as a hedge against uncertainty. And I don't think about the price of gold. I want to own gold. I want to keep my savings in gold and then exchange it for things that I want to own more at a given point in time. And the point I was making in my presentation was, you look at gold's purchasing power, not the price. So in 2008, for example, gold spiked into the Bear Stearns collapse. It performed incredibly well. And then when Bear Stearns went under, it fell. And everybody was saying, what the hell's going on? Why gold's not supposed to fall in times of crisis? But it was liquidity. And people that had margin calls were selling gold because it's liquid capital. But importantly, as gold fell 30%, it quickly rebounded. The S&P went on to fall 65%. And so even though gold was down, your purchasing power increased. And that's how I try and get people to think about gold, is the price went down, but if you can buy twice as many units of the S&P today, even with a reduced price in gold, you might want to own the S&P more now because it's corrected 66%. So I just think of it as a liquidity reserve and capital, and I think to exchange for other assets as and when the relative values align. And if you think of it in those terms, gold has done tremendously well. If you look at headline terms, since 2000, when it bottomed, when the central bank stopped selling gold, it's outperformed the S&P, it's outperformed the Dow Jones, it's outperformed the S&P on a total return basis. And all you've had to do is sit there with it in a safety deposit box. You haven't had to worry about all the ups and downs in the market, which stocks to pick. It's just outperformed them. And I suspect that outperformance will actually increase if we get some instability in equity markets in the US particularly, which I fully expect to see before this year's out.
How geopolitical is the gold price right now?
It's becoming more so. Yeah, it's a great question. It's becoming more so because we are seeing central banks aggressively buying gold. There's only so much of it. There's only so much additional supply every year. And when you have an increasing number of price-insensitive buyers looking to acquire it, that tends to lead to higher prices. But more importantly, the reasons these central banks are trying to buy gold is because it's a national security imperative. You know, once the US Treasury froze Russian assets when they went across the border to Ukraine, every single central bank in the world that owns dollar reserves was on notice that this could happen to you. And while the majority of them, I'm sure, think, well, we're on the same team as the US, we're not going to upset them, they can't take that chance now because it's been proven that it can happen. And if your reserves are a national security imperative, which they obviously are, you cannot have them at the whim of a capricious foreign government. And gold is essentially the only neutral reserve asset out there. And that explains why central banks are moving to acquire gold. And I think that is going to make gold more of a geopolitical asset. It's going to be a tailwind for the price. And I think that's a big part of why we're going to see a good year for gold this year.
Williams acknowledges the once unthinkable notion of inflation surpassing the 2% threshold, but asserts its feasibility, especially if the Federal Reserve implements drastic measures like interest rate cuts. He underscores the importance for central banks to be sure about conquering inflation before considering interest rate cuts, echoing sentiments from the Organization for Economic Cooperation and Development, OECD. Despite revisions to its outlook indicating a faster-than-expected decline in inflation, the OECD emphasizes the need for caution, with the U.S. inflation rate projected to be 2.2% in 2024, down from a previous forecast of 2.8%. Jerome Powell, head of the U.S. Federal Reserve, also emphasizes vigilance against premature interest rate cuts. Williams highlights the concerns surrounding wage inflation, noting the difficulty of reversing wage increases once they occur. This concern is supported by recent data showing a 0.6% increase in average hourly earnings in January, surpassing gains reported in previous months. With wages rising 4.5% over the past 12 months, persistent wage growth may signal ongoing inflationary pressures as higher labor costs potentially translate into higher consumer prices. Let's get back to the interview.
And if you think about that, for the longest time, it was almost impossible to conceive inflation above 2% because they couldn't get it there no matter what we did. So could it get to 9% again? Absolutely it could. It would take probably actions by the Federal Reserve in terms of slashing interest rates to see inflation get out of control again. But the wage price stuff does worry me because it's very, very sticky inflation. And so I always worry when they hang the mission accomplished banners, and they did that at the tail end of last year, talking about how they've got it under control and talking about, signaling cuts because they know that the market needs that promise of lower cost of capital in order to function properly now. And that's the world they've created with their policies. So they have to try and maintain it. Ultimately, it is doomed to failure. It just is. And the math just doesn't work after a certain level. But again, everybody is very happy to play along because it's easy to make money when interest rates are low and asset prices are rising. So people tend not to put their fingers in their ears and shout la la la. But when rates are going up and when inflation is a problem, we saw what happened in the bond market through last year. We saw what happened in Silicon Valley and the Signature Bank back in March. Once these problems become real and they have to be faced, banks going out of business and prices going up and people out in the streets and all these things, to say that inflation as a concern is over, I think is way too premature. Way too premature.
Everybody sees that onshoring is another trend as well, or reshoring, whatever you want to call it, bringing production back home, comes with cost and wage inflation.
Look, it does. And the question is it a choice or is it a policy? Is it something that they decide they're going to do, or is it something they have to do because other countries are forming blocks left and right that are antagonistic towards the US? The US needs to secure its supply chains. COVID's proven that. And the only way to really do that is to move it back onshore or to friendly countries. Maybe move it to Europe. Mexico is obviously a favorite destination right now. Moving it to Europe is expensive. Moving it onshore is even more expensive. The chances are that's going to lead to higher wages and higher costs. So we just have to deal with that. And I think after so many years of low inflation, we just have to accept that we're in a world of higher inflation for a while, and it's just going to be that way. I think inflation is still a very important subject to have a handle on. Everyone thinks it's dead, and the Fed have hung the mission accomplished banners up and everything's gone away. I don't think that's the case. I think it's still there. We saw just today, a big strike at one of the universities in California, all the faculty walking out wanting much bigger wages. I think we're going to see more of that, and wage inflation is the worst inflation of all in terms of how entrenched it gets. You can lower prices of food if you increase them. It's tough to lower wages once you increase them. So I think inflation is still something that we need to worry about. And I come back to gold. I think gold is time for gold. I think all the pieces are in place for gold to become a much bigger part of the macro conversation. I think the reasons for owning gold have been strong for a while, but they're starting to be strong for a lot more different groups of people, particularly the central banks. So we've seen them buying more gold the last 2 years than they have since 1950. And that's important because they don't care what the price is. They just need to own it and diversify out of their currency reserves into a neutral reserve asset. So I think there's a lot of tailwinds for gold. So for me, Japan, gold, and inflation are the three things that I'm kind of keeping an eye on.
The gold price faces challenges in gaining momentum, influenced by a mix of contrasting factors. Expectations of a hawkish stance from the Federal Reserve, coupled with high U.S. bond yields and a strong U.S. dollar, exert downward pressure on the metal. However, geopolitical tensions and concerns surrounding China's economic challenges support the commodity. Considering the current landscape, what factors do you believe will significantly influence gold prices moving forward? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.